welcome back to the Mortgage Reports. If you've been learning about reverse mortgages, you've probably heard the term HECM, which stands for Home Equity Conversion Mortgage. And once you start looking into HECMs, one big decision pops up pretty quickly. Should you choose an adjustable rate HECM or a fixed rate HECM? Now, for many homeowners, this choice can feel a little overwhelming. The words adjustable rate alone might bring back memories of the 2008 housing crisis or make people worry about unpredictable payments. But in the world of reverse mortgages, ARMs and fixed rate options work very differently than they do with traditional loans. So today, we're breaking this all down in a simple, easy to understand way. We'll walk you through the key differences, who each option might work best for, and a couple of real-life examples to show how this plays out in retirement. Question 1. What is a fixed rate HECM and how does it actually work? Well, a fixed rate HECM is exactly what it sounds like. The interest rate stays the same for the entire life of the loan. With this type of reverse mortgage, homeowners usually take the funds in one large lump sum at closing. Now, there are no monthly mortgage payments required, just like with any reverse mortgage, but the key thing to know is that you don't have flexible access to funds over time. You're basically locking in the rate and receiving the majority of your available equity all at once. This option tends to work best for homeowners who have a specific immediate need for a large amount of money. For example, paying off an existing mortgage, consolidating high interest debt, or covering a major one-time expense. Now, since the rate is fixed, you also get predictability when it comes to how interest will accrue over time, which some people find comforting. Question 2, what about an adjustable rate HECM? How is that different? Well, an adjustable rate HECM works a bit differently. Instead of taking all the money in a single lump sum, you can choose to receive the funds as a line of credit, monthly payments, or a combination of both. The interest rate can change over time based on market conditions, which is why it's considered adjustable. However, in a reverse mortgage, an adjustable rate doesn't affect a monthly mortgage payment since you're not making payments to the lender while you live in the home. Instead, the changing rate simply affects how quickly the loan balance grows over time. One of the biggest benefits of an adjustable rate HECM is flexibility. If you don't need all of your money right away, your remaining line of credit can actually continue to grow over time, giving you more access in the future. Question 3. Why would someone choose an adjustable if fixed feels more predictable? Well, this is such an important question. While fixed rates do offer certainty, an adjustable rate HECM often provides more long-term financial flexibility. With the line of credit option, you can take money only when you need it, rather than all at once. That means your loan balance grows more slowly, which can help you preserve more of your home's equity over time. It can also act as a kind of financial safety net. If unexpected medical expenses, home repairs, or cost of living increases come up later in life, having that growing line of credit available can offer real peace of mind. So while the rate itself adjusts, your options for accessing the money can actually give you more control overall. Question 4, can you switch between fixed and adjustable after you close? No. Once you choose your rate type and close on your reverse mortgage, you're locked into that structure. That's why this decision is so important up front. It's less about trying to beat interest rates and more about choosing the option that best matches your financial habits, health outlook, long-term goals, and comfort level with the flexibility versus predictability. Question 5, what does this look like in real life? Okay, so let's meet Susan, age 70. Susan still has a traditional mortgage balance of $110,000, and it's becoming difficult to make the monthly payments on her fixed retirement income. She chooses a fixed rate HECM because her main goal is to eliminate her existing mortgage completely. She takes the funds as a lump sum, pays off her loan, and now has no monthly mortgage payment. For Susan, the fixed rate option makes sense because she needed a large amount right away and values knowing the rate won't change. But now consider James, age 68. He owns his home free and clear, but is worried about rising healthcare costs and inflation over the next 20 years. He chooses an adjustable rate HECM with a line of credit. He only pulls from it when necessary. Now, for home repairs, travel, and helping his grandkids with college, and allows the rest of the credit line to grow over time. This gives him flexibility and access to more funds in the future if he ever needs them. Now, both options work, but for very different reasons and lifestyles. Question 6. So, is one better than the other? There's no universal best option, and that's really the key takeaway. A fixed rate HECM can be perfect for someone who wants a one-time payout and total predictability. An adjustable rate HECM is often better for someone who wants flexibility, future access to funds, and a built-in safety net. The best choice depends on your age, your current mortgage situation, health, lifestyle, financial goals, and how long you plan to stay in your home. That's why taking a reverse mortgage and speaking with a reverse mortgage specialist is so important. They can walk you through real numbers for both options so you can make a truly informed decision. Now, when it comes to reverse mortgages, choosing between an ARM and a fixed rate HECM isn't about guessing where interest rates will go. It's about choosing the structure that fits your life. Now, whether you want stability, flexibility, or a mix of both, there's an option designed to support your retirement. Not complicated. So if you found this helpful, give the video a thumbs up, subscribe to the Mortgage Reports, and hit the notification bell so you never miss an update. And if you still have questions about which option is right for you, drop them in the comments below. We'd love to help. You can also find a full breakdown and expert insights linked in the description. Thanks so much for watching, and I'll see you in the next one.